Hello everyone, this is Tim at Master the Gap. If you're trading the opening gap in Google, some historical data could be a huge advantage to you relative to seasonality. So what is the best day of the week to trade Google, and what's the day of the week that you should avoid gaps in Google? But before I share the information, let me tell you a little bit about the testing parameters that we used. All this testing, back testing if you will, was done in TradeStation. We used the very first date that was available in TradeStation for historical data for Google, which was August the 20th, 2004. We ran that through the 13th of August, 2010. The session time that was used was 9:30 a.m. Eastern Time till 4 p.m. Eastern Time. The minimum and maximum gap size we did as a percentage of the 5-day ATR. Average true range is what ATR stands for, and that gives us a volatility basis using a minimum of 5% of that value to a maximum of 100% of the 5-day ATR. The stop size was used is 30% of the 5-day average true range. The target is yesterday's or the previous day's close, or gap fill if you will. And the entry that was used was a market order right when the market opened, 9:30 a.m. Eastern Time. Now of course you could use other triggers, but the way we tested the data is based on our standard methodology at Master the Gap of entering specifically at the open of the market. We traded 100 shares and used a commission of $5 per round trade. There was no slippage that was factored into this data. So let's take a look at what the data looks like for day of the week trading Google. The first thing that jumps out is Mondays are a day that you could avoid gaps on Google, and Fridays are days that certainly are advantageous to trading Google gaps. So if you look at this number, all means that it's looking at both long and short. So let's first start by defining what long and short means. If you have a gap down, meaning that the open occurs lower than the previous day's close, that's a gap down, and you would buy long, enter the market and buy long at the open, targeting the gap fill of the previous day or the previous day's close. If you had a gap up where the open of the day was greater than the previous day's close, you would go short. That's what's known as fading the gap. You would go short and target the previous day's close, or what we call gap fill. So basically we have this table separated so that you can take a look at the shorts, the longs, or the combination of the two. So I won't allow you to absorb the information on your own, but I won't really go into much other than you can certainly see that during the middle of the week the profit factors, and if you're not familiar with the term profit factor, that means you take all of your historical profits, divide by your historical losses. Any value greater than 1.0 means that that particular setup historically has made money. So you can see everything is greater than 1.0 with decent win rates here, 62, 63%, pretty consistent all the way through the middle part of the week. But the first part of the week on Monday, 53% win rate in a losing proposition because you're less than 1.0 with a 0.9 profit factor. And then on Friday, 66%, the highest win rate of the week, and a 1.6 profit factor. So great information to have if you're a Google trader. And if this kind of information interests you, we have done a basic gap study that you can learn more information about at masterthegap.com/Google. So check out that link at masterthegap.com/Google. It'll give you some great information on what this study encompasses and how to get a copy of it on your own. As always, any questions that you have, feel free to email me directly, tim@masterthegap.com, and I'll be happy to help you any way I can. Good trading.